Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Bull versus Bear webinar. Steve Miley on the call for Trade Day. Welcome, everyone. Well, we've got lots of hellos in here. Welcome, Eldar. Welcome, Richard87. I bet I can guess your birth year, Richard. Welcome, Jack. Welcome, Rob. Welcome, everyone. And anyone else wants to say hello, welcome to anyone who's a bit shy. Welcome, everyone, to the Bullseye Bull versus Bear webinar in here with Steve Miley for Trade Day. I've already said that, right? It's Thursday, the 15th of June. Let me get on. Right. First of all, well done. If you survived CPI and Fed, good job. Wasn't kind of that spectacular through the Fed, but we had a bit of price action. We did have to fail a few traders. Beware, we had to fail a few traders who were trading through both CPI and Fed the last couple of days in here. Just as a heads up, no webinar tomorrow. Okay? I'll put that into the chat in here as well. No webinar tomorrow. If anyone comes on a bit later, hopefully they'll see it in the chat. Unfortunately, I can't make the webinar picking my son up from university, so I won't be able to do the webinar, and James is traveling. So no webinar tomorrow, but I'll cover what's probably coming up into tomorrow. Today I won't be able to cover obviously what happens today, but yeah, let me take a look at what we've had, what we've got coming up, what have been the events, the geopolitical, the central bank, the data events that are impacting financial markets right here, right now. Obviously, there'll be a big focus on the Fed. I'll talk about Fed, what they did, what they said, why it moved things, why it didn't move things, blah, 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 blah. Then there are some other things from non-US markets that are important that I will cover as well. And then we'll have a quick look at the charts in here. So in here, first of all, looking back, Fed, as anticipated, Fed pulls. Okay. Now, remember, I think I shared with you yesterday this article from one of my that we put up on FX Explained, like one of my another site that I'm involved with, from one of my colleague Richard Parody, and he spoke about going on a hawkish hold. Right. I think I mentioned this to you guys yesterday. I think he nailed it. Right. It was a hawkish hold yesterday. I don't know if he borrowed that from somewhere else, but look, tough talk will do the heavy lifting for now. That's what they did. It's exactly what they did. And what does it mean? What has it meant? Well, it meant that the dollar strengthened. He said about the dollar strengthening in here. A hawkish hold would do the heavy lifting for the initial market reaction over the coming days. It will probably prevent yields from dropping. Well, yields are actually, it has prevented them from dropping, and they're going up, and help to prevent the slide of the dollar. And it's done that as well. The dollar's going up and gold going down on the back of it. So, I know you guys are mostly looking at the ES and the NQ, and you're trading S&P and NASDAQ and indices, but people are trading other stuff. I just want to point out these other markets. Dollar strengthened on the back of it. No surprises. Yields, particularly at the short end, have gone up. They've gone up more aggressively at the short end than they have at the longer end. 2s and 5s are breaking to new multi-week yield highs. 10s and 30s are not quite there yet. So that means we're seeing a steepening of the yield curve. A steepening of the yield curve going back to steep levels not seen for multiple weeks, multiple months. And that's an indication of potential recession. The market, the yield curve. Now, there is an article we've got on... let me go and find it on Trade Day, actually, in here, and you can get it into the back end, but it's in here. I know it's in here. If we go to the trading advice from the front page in here, and we've got, what is it? It's on the advice thing. Yeah, what is yield curve inversion? This is an article I did this sometime last year. Forgot the date on this. Does it show the date? Put this up like last year, but this is when the yield curve initially inverted, right? So, and it was talking about why it's important. Okay, so there we have it. Why is yield curve inversion important? Okay, and what is yield curve inversion? Talks you right the way through if you know nothing about it. Okay, in here. So and why it's important, and this is talking about it when actually, okay, what is currently happening? Q1, Q2 of last year. So I wrote this about over a year ago actually, but it's still relevant now because what we're seeing is that the yield curve is inverting even more again, and it's indicating potential inversion. Will we have a webinar on Monday, US Juneteenth? I don't know is the answer to that, Jack. I completely let it slip my mind that it was Juneteenth. It's not. I'm in the UK, obviously. We don't celebrate Juneteenth, and I know it's becoming an increasingly big deal in the US. I can't remember market. I'm gonna have to do a little bit of research to double check if markets are closed or not. And so we will post all that in the forums, though, right? So please keep an eye on the forums, keep an eye on the heads up. There won't be a webinar tomorrow, as I say, because we're unable to make that. There may not be one on Monday as well. If markets are closed, we probably won't have one. If markets are not closed, I'll probably do one. Okay. So watch out in the forums, watch out in the heads up. Okay. Take a look at that. This on the yield curve inversion, though. Okay. So yield curve's inverting, the dollar's strengthening, and yields are generally rising, and gold is weakening. Dollar strength often equals gold weakness. Gold broken down through. Looked like it was trying to form a base. It's now broken down through lows. So Richard in here in this article on FX Explained pretty much nailed it. Got another article. Richard's written another article for us on. Has he? No. I think he's got another one going up on here on the ECB. Another article on the ECB. So we'll going up later, and I'll post that later on the ECB. I'm going to put something up on the Fed a little later. So watching out back into here. Okay, there will be an article on the Fed in here coming up a little bit later. I've almost finished it. I'll post it in probably the next hour or two in here. So watching out for that. I'll put it in the forums as well. Watching out this on the Fed in here. But yeah, so the Fed yesterday, a hawkish hold. I think we're going to class that as, okay. So going into 5 things to start your day. There's not a lot in here. I'm going to skip a lot of this. I've got quite a lot to say, and I want to get through this. You guys want to get on and training. So markets are lower in here this morning. I'll talk a little bit about for why there. We haven't got a lot of big data now coming up. US jobless claims, weekly data rarely moves markets. It's not going to do a lot, but we do have stuff coming out. Obviously, ECB is coming up. Talking about OpenAI now, ChatGPT, and China chip making equipment, Applied Materials suing a Chinese rival, blah blah blah. Right? None of this is that interesting. This is what's interesting about the Fed. Okay, and I'm going to skip straight to the dot plot chart. We spoke about the dot plot chart yesterday. A big leap in the dot plot chart. So in here, you see now the Fed telling us 2 more hikes to come. Right here, this is where we are now between 5 and 5.25. I'm going to make this a bit bigger. So this is the official dot plot chart, okay? Each one of them, each dot is from each member of the Fed telling you where they think rates are going to be. When, let me make this back smaller again. At the, no. Here it is, at the end of 23, at the end of 24, at the end of 25, and longer run, okay? So just zooming back in again. Each one of these dots represents where they think it's going to be, okay? So if you can see in here, the majority in here, the consensus is all there, okay? And that is rates between 5.5 and 5.75. Remember where we are now? We're here. 500 to 525. Okay, so the dot plot chart in here is telling us they expect rates to be 5 to 575. So up 50, 2 more rate hikes. That's why all the headlines are saying 2 more rate hikes, is because of this. Okay, because what the dot plot chart is telling us. Okay, and you got a couple even wanting more aggressive hikes. Okay, into year end. And a few saying we should be, only 2 though saying we should be 5 to 525. That's where we are now, okay? So whether we're going to be up 25 or up 50, the Fed are telling us we're going to be up 50. That's where most of the Fed members are sitting in here, up 50 from here. And what does the CME tool tell us now? Well, look, if we go look at July now, pretty much starting to nail on for a July hike, okay? 75 basis points, okay? And then if we go to September, still up, November, still up, and then December now still up. We've now got over a 60% chance in here. 60% chance in here that we will be higher in rates by the end of the year. Okay, where before, remember, we were looking up 25, down 25. That was according to the curve, the CME tool, the curve in here. This is off the futures contracts. Okay, so now the market is pricing in up and then staying up. Okay, up and staying up, and there is a chance that we're going to go higher. And the Fed are telling us we should be here. Look, only a 9% chance saying that we're going to be up 50. The Fed, however, are telling us that's where we're going to be, up 50. Okay, so the economy, so we're still seeing in here a far more of an aggressive, a more dovish tone from the market compared to the Fed. All right, let me just fly through some of this stuff in here. So on the back of that, so initially stocks held in yesterday, but overnight in here we've had some other stuff going on, but really I think the markets have the European and Asian markets have taken a look and gone, that's fairly hawkish, and they've reacted negatively, and we've seen stocks go lower. So European stocks are lower in here. Actually, Asian stocks did okay. We've actually had a rate cut in here from China's central bank. Okay, so I'll talk about that a bit further along the line. But we've got some negatives out of Europe in here. European gas prices are going higher. European gas prices going higher was one of the big causes that caused electricity prices to go higher, and it was the real concerns and drove inflation in Europe up last year. European gas prices have been going higher over the last 2-3 days. I cover this for a institutional client. Okay, I look at the technical analysis on gas prices. Gas prices in Europe and the UK have been pushing higher. I know you guys are not trading this, but it's important because it feeds directly into inflation. And there are real concerns about that in here at the moment, okay? And this is not helping. We've had this European gas price because of major production to close. I think I've got an article on that. Yeah, here it goes. European gas prices spike as major gas site to close, okay? It doesn't sound like a big deal to you guys, but believe me, gas prices are flying higher in here at the moment. I think they've doubled in the last week. Pretty much in here, European gas prices, okay, and that's not good for electricity prices as well, and that can put obviously upward pressures on inflation. It's something the ECB are probably not directly talking about, but they're going to be a little bit concerned. Okay, we've got ECB obviously coming up. Just to run through some stuff on the Fed, so they've got the dot plot chart showing the medians. We've already kind of covered that in here. Powell indicates at least 2 more rate hikes after the pause, but the market's not pricing that in, so the market's still more dovish. Stocks slip overnight, and then again here from Reuters, futures fall as Fed signals more rate hikes. Bond traders step up bets the Fed will steer US economy into recession. Where's that coming from? It's the yield curve. Just been talking about that. 2 years, 5 years, going much quicker, higher in yields. Look, I've got all them open here in investing. Here's the 2-year yield. The 2-year yield at the end of May spiking higher in here because of the US debt ceiling concerns. And then there's the relief from the US debt ceiling. But since then, higher, higher, higher. Real concerns in here. This is showing you. This is the 2-year. This is the short end. Here's the 2-year. Here's the 5-year. No, there's the 5-year. Again, going above the peaks from the debt ceiling concerns. They went above there even before the Fed, and then up yesterday, choppy yesterday, but then up again this morning. This is what's driving the equity markets lower today. 2 years and 5 years going higher, right? 2 years going higher again, the 5 years going higher. And I tell you what, you really, in my opinion, need to watch is this. Look at the 10-year. This is the 10-year yield. It went higher post CPI. It went higher post CPI. It kind of consolidated yesterday, but then this morning pushing higher again. If we break above that high yield at 385, that's going to be a worry. And if we go and take a look at it in a second on the actual, look at it now on Tradeovate. Okay, so here is and then also I'll go back to the 30-year, and here's the 30-year. The 30-year is very much caught in a range. Okay. If this starts to break higher as well, this will be a bit of a concern, okay? These are not breaking higher because of the recessionary fears, okay? This is what it is. No one's buying, this is not going up in yield because of concerns around inflationary pressures and because of concerns around short-term inflationary pressures and longer-term recession. That's why longer end yields are not going up, okay? That's why longer end yields are not going up because of recessionary fears in here, okay? And if we go and take a look in here, this is the 30-year. You can see same, caught in the range. Here's the 10-year. This is going to be 10 years already broken below the lows on the futures, okay? If we break back below yesterday's lows, that's going to be concerned, but much more because of the price on futures gets kind of warped a little bit, okay? The yield doesn't get warped, okay? This is the real one to watch. Okay, if yields start to go above yesterday's yield peaks and the yield peak in here, so 385 on 10 years, and that will simply mean on the futures, if it goes back below yesterday's lows, if we start to break below 112.10 on the September 10-year, it will be a concern. I think that could lead to stocks going even lower. You need to watch, in my opinion, you need to be watching this if you're trading stocks. This could be a trigger, lower bond prices, but on the longer end, okay, driving the stock indices lower, okay? Right, enough of that lecture on that one. What else have I got in here for you? So bond traders, investors see more Fed rate hikes and no cuts till 2024. That's a poll on Bloomberg. No cuts till 24. ECB. So we've got the ECB coming up today. That could have an impact. The ECB now coming up. I've already done the look back. Also, I just want to quickly mention China. China retail sales number overnight worse than expected. The PBOC also eased rates on their longer term. Remember, early in the week, they did the 7-day repo. That's a very short. That's intrabank market rates. They cut the 1-year rate in here overnight as well. Okay, to try and stimulate the economy, because the data continues to worsen. It comes in worse than expected out of China. And then going back in here to today, remember we do have ECB coming up in less than an hour. Where's the US? Today. Where are we? Here we go. 30 minutes time. In 30 minutes time, we get the ECB, and then another, I think it's 45 minutes after that. Where's the ECB presser? Here it is, Lagarde press conference at 8:45 Eastern. So 30 minutes time, we get the decision, and then we get the press conference after that. What we're expecting a hike from the ECB to raise rates further as economy stutters. We're expecting it up, and this is a good little guide in here. If you want to know a bit about the ECB, I do see your question there, Jack. I'm going to come back to that. ECB enters home straight decision. So what we're expecting is them to go from 3.25 to 3.5. But if you look in here, the expectation is for rates to peak at 3.75. Are they going to signal that? Are they going to give us an indication of that? Are they going to, in the press conference, are they going to tell us that maybe we've got another one and done in July or not? Are they going to stay more hawkish? We'll have to wait and see. We'll know more in 30 minutes time, but more in the press conference. And the oil continues to be negative in here with concerns about China's slowdown, concerns about that inversion of the yield curve in the US showing potential recession, on concerns of higher interest rates in here. What else do I have? European gas prices, and there's the China. China's weakened economy puts focus on stimulus. PBOC cut the 1-year policy rate in here overnight, and the data showing slower, as we've already looked at. And then just incidentally, just to add on in here, in case you missed it, this has been relatively recent, I think, in the last hour or so. North Korea. Now, they do this relatively recently, but they've launched a potentially ballistic missile in here, according to Japan, into the Sea of Japan. They do these tests fairly regularly, but again, quite a common event by now, but should never be taken lightly. Too true, right? Where are we overnight? Well, Nikkei, which has been tearing higher, didn't do much. Hang Seng actually went higher on the back of that rate cut. But if we look this morning in here, the DAX and the CAC are down about 0.5 to 0.7% in here, the German and the French indices. The FTSE is pretty much unchanged in the UK. And overnight in here, we see 0.7 down on the NASDAQ, 0.4 nearly down on the S&P, having kind of marked time, not really gone anywhere yesterday. So a quick look at the charts there. I do think this is a concern. If we get a break above, I think you need to be watching. I've already said it. I'm going to say it again in here. If the 10-year breaks above 385, on the futures, if we just break, I think, below yesterday's lows, which are at 112, 12.5. So a little bit below there is going to take you probably through 385. So through like 112.10, 112.09 on the futures will probably take us through 385 on yield. That would certainly be a negative in here. And going to the markets there. Now, I know in my daily from last night, I'm kind of hanging on and staying positive, right? But that was before we had the wobble that we've had this morning. If we go and or overnight in here, if we go and take a look at the daily in here, this looks wobbly, right? This looks like, this is potentially, right, this up here as a candlestick in here. So you've got this as a hanging man, right? A hanging man, which is a potential reversal. It's only through the low. Now, we've got a long way to go to the low, but this looks quite negative to me. The price action this morning, there's the spike and rebound in here through the Fed. Okay, that's the spike down and then the rebound. I think this looks quite negative. And look, you see we're sitting right. You see we had this next spike. We've got that spike low there. So on the S&P, 43.54.75. I think that's right. Is that right? Yeah, 43.54.75. Through 43.54.75, that looks negative. Similarly, on the NASDAQ, you get that secondary spike. Actually, we're through the lows. That secondary spike, we're already through those lows on the NASDAQ this morning. Okay, so that looks quite negative. And there's that pre-spike low back below like 14.870, 865. It looks wobbly for the NASDAQ as well. I don't like the chart the way it's shaped up this morning. Now, last night, it looked fairly healthy. This morning, I think we've got a down day. I'm going to wrap it up there, actually, guys. Question from Jack, though. Question on trading psychology. What are some ways you manage FOMO? For instance, taking quick profits, only see it run 5 times more. This is what I do on the one-to-ones, Jack, right? I'm going to do this very quickly, right? You play devil's advocate with yourself, right? You literally hold a we don't. I mean, I know you guys are in the US, so you don't literally. You don't hold a gun to your head. Never hold a gun to your head, right? Sorry, I forget you guys in the US. We don't have guns in the UK. You hold a pretend gun, right? So I'm doing a pretend gun with my hand. You know, you do a pretend gun. You put your two fingers out, and you got the little trigger, right? You hold the pretend gun to your head, right? If you're long and you're in the money and it's going towards your target one, but you think it could go to target two, to target three, target four, right? But you'll get fear. We get fear. We all get fear as traders, right? It's fear of missing it. It's fear of you don't want to give the profit back. You're in the money, right? So you take a quick profit. Why don't what you do is this: you play devil's advocate for yourself. You literally, and this is psychological, you need to do this, right? It'll get you in the habit. You'll remember Uncle Steve told you to do this, Jack, and everyone else, right? You hold a metaphorical gun to your head, not a real gun. You put your fingers to your head and hold them up to your head, right? And you say to yourself this, right? If you're long, you say this to yourself: would I sell it here? If I was forced to be short, would I want to be short here? If the answer's no, then why are you cutting your long? Okay, makes sense? And that'll keep you in the trade a bit longer. If the market's ramping up and I say to you, would you sell it here? And you say no, then go, well, why the hell are you cutting your long? Okay, try that. Okay, and the reason you do the gun thing because you need a physical cue. You don't want to just think it; you physically do it, and it will start getting you in the habit of doing that. And then over time you won't need to put your fingers to your head anymore. Make sense? So you challenge yourself. You play devil's advocate with yourself, right? And you say to yourself, would you, Jack? Would you sell it here? You know, you're long. Would you go short here? No. Then why are you cutting your long? Okay, that's my little bit of a tip. All right, guys, I'm going to wrap it up there. I will post now. I saw that Jim, thank you, market close. I'm going to quickly Google that because it might be the cash. What have you got there? Market holidays, but sometimes it's a stock market holidays. So sometimes though the cash market is closed in here, right? Sorry, are you still there, guys? You still see the screen? Oh, you can, right? Let me see. This is what you just shared with me, right? So, but sometimes, yeah, sometimes the cash markets are closed, but I think the futures are probably on partial day, right? Bond market, stock exchange. Yeah, let me go and take a look at the CME. The CME one is not great. CME calendar. Juneteenth's on there, yeah. So they're going to have some kind of holiday. So it's going to be a partial day. It'll be partially closed. Here it is. Here, right? Search by asset class. I know most of you are trading the indices, right? Oh, missed it. Where was it? US index. Weather. Nice bit of weather. G10 US index. What is that? That's not it. S&P. Here we go. So Sunday pre-open 5 o'clock open. That's as normal. Monday pre-open open. Okay. Tuesday. Yeah, it looks like it's a partial day, right? I think it's a partial day. So I'm going to say we won't have a webinar, okay, Jack, because I want to encourage you guys not to trade, okay? It's a partial day. I would say don't trade, okay? And unfortunately, no webinar tomorrow as well. So the next webinar will be Tuesday, all right? So no webinar Monday. We will put up about the Juneteenth holidays in the forums and on the heads up. My strong advice is don't trade, and remember the early closes. You have to be closed out 10 beforehand, so make sure you're closed out, otherwise you'll fail, okay? The evaluation. All right, guys, but my strong advice is to take the holidays while they're there, and there's plenty of other trading days in the week. All right, guys, or in the year even. All right, I'm going to wrap it up there. Have a good one, guys. Bye-bye. Have a great trading day.